In financial reporting, a critical pivot occurs when an asset stops generating value through daily use and instead waits to be sold. When this shift happens, IFRS 5 takes over. It provides a strict protocol for this transition, shifting the accounting focus from a cycle of long-term use to a specific framework for imminent disposal. We can see the first step of this protocol in this flowchart. The central test asks a simple question: will the asset's carrying amount be recovered principally through a sale transaction rather than continuing use? If yes, we move down a strict pathway. To take that yes pathway, the sale must be highly probable. This requires the appropriate level of management to commit to a specific plan to sell, and they must have already initiated an active program to locate a buyer. Furthermore, the asset has to be actively marketed at a price that is reasonable relative to its current fair value, and the sale must be expected to close within exactly 1 year from the date of classification. These criteria are rigid by design. They prevent management from reclassifying assets based on vague intentions, ensuring that the financial statements reflect specific transactions rather than future hopes. While the criteria are strict, they do not apply universally to every non-current asset on the balance sheet. This grid outlines the explicit boundaries of the standard. Assets that are already measured at fair value or are governed by highly specialized regimes, like deferred tax under IAS 12, employee benefits under IAS 19, financial instruments under IFRS 9, or investment property at fair value under IAS 40, are excluded from the IFRS 5 measurement rules. There is also a built-in tolerance for timeline disruptions. If the 1-year completion requirement is delayed by events entirely beyond the entity's control, the classification holds, provided there is sufficient evidence the commitment to sell remains firm. However, assets slated to be abandoned never qualify for this classification. Because their carrying amount will be recovered by running them into the ground, they remain under continuing use until they are permanently closed or scrapped. Conversely, if an entity acquires a subsidiary exclusively with a view to resell it, those assets and liabilities bypass the typical wait and enter the IFRS 5 framework immediately upon acquisition. Entering IFRS 5 is an objective logic gate. It is not a menu of management choices. Once the facts on the ground meet these criteria, the accounting treatment shifts mandatorily. This diagram illustrates that mandatory shift in measurement. Under standard rules, we look at recoverable amount. Under IFRS 5, an asset must be measured at the lower of its carrying amount or its fair value less cost to sell. The immediate operational consequence of this shift is that all depreciation and amortization on the asset must completely stop. Let's trace how this affects the ledger over a multi-year period. At year 0, an entity holds an asset with a historical cost of $1 million and accumulated depreciation of $400,000. That leaves a carrying amount of $600,000, with 6 years of remaining useful life. On January 1st of year 1, the asset meets all criteria for sale. Management determines the fair value less cost to sell is $500,000. Because the current $600,000 carrying amount is higher, it must be adjusted downward. The entity records a $100,000 impairment loss directly to profit and loss, crediting the asset held for sale account. The carrying amount is now locked at $500,000. Over the course of year 1, no depreciation is charged against the asset. But by December 31st, market conditions have worsened, dropping the fair value less cost to sell to $450,000. The entity records another $50,000 impairment. Halting depreciation and recognizing immediate impairment losses shifts the asset's financial profile. The ledger no longer tracks a tool used for production. It tracks the net value of an upcoming market liquidation. But markets are volatile, and conditions can improve just as easily as they deteriorate. By December 31st of year 2, a surge in demand pushes the asset's fair value less cost to sell up to $620,000. The standard allows entities to recognize a gain for this subsequent increase, but with a strict ceiling. Reversals are mathematically capped at the cumulative historical impairments recognized on the asset. Here, that's $100,000 from the initial reclassification, plus the $50,000 from the end of year 1. We take the current carrying amount of $450,000 and add the maximum allowable reversal of $150,000. The absolute ceiling limit is $600,000. The entity debits the asset held for sale for $150,000 and credits a gain on reversal to profit and loss. This ceiling serves a precise function. It corrects past pessimism without crossing the line into recognizing unrealized gains above the asset's historical cost structure. Sometimes the anticipated sale simply falls through. In year 3, management entirely abandons the disposal plan, and the asset no longer meets the IFRS 5 criteria. When an asset is pulled back into continuing operations, it reverts to the lower of its current recoverable amount or its adjusted carrying amount. Look at the timeline. The adjusted carrying amount simulates what the book value would be right now if the asset had never been classified as held for sale. The original $600,000 value minus the 2 years of skipped depreciation yields an adjusted carrying amount of $400,000. Management determines the current recoverable amount is $420,000. Because the adjusted carrying amount of $400,000 is the lower of the two figures, that becomes our target measurement. The current book value is sitting at $600,000 from our year 2 reversal. To bring it down to the $400,000 target, the entity must book a $200,000 downward adjustment, charged directly to profit or loss from continuing operations. The IFRS 5 framework acts like an elastic band. If a sale fails, the math aggressively snaps the asset back to its historical depreciation schedule, ensuring the financial statements look as if the diversion never happened. Up to this point, we've examined individual assets, but when divestitures scale up to the macro level, we cross the boundary into discontinued operations. A discontinued operation relies on the concept of a component of an entity. This is a segment of the business with operations and cash flows that can be clearly and operationally distinguished from the rest of the company. To qualify, this component must represent a separate major line of business or geographical area, be part of a single coordinated disposal plan, or be a subsidiary acquired exclusively for resale. This Venn diagram clarifies the relationship. Every discontinued operation must be classified as held for sale or already disposed of, but not every asset held for sale is distinct enough to qualify as a discontinued operation. By requiring operations and cash flows to be clearly distinct, the standard prevents routine asset turnover from being categorized alongside massive strategic divestitures. To isolate divestiture effects on the statement of comprehensive income, results are collapsed into a single line item near the bottom. This aggregates the component's post-tax operating profit, combined with any post-tax gain or loss recognized on fair value measurement or final disposal. On the statement of financial position, disposal group assets and liabilities are presented separately from the continuing business as current items. Offsetting the assets against the liabilities is strictly prohibited. They must remain physically separated. The footnotes provide the final layer of transparency. Entities must disclose a full description of the asset or disposal group, the expected timing of the sale, the specific profit and loss lines containing measurement gains, and the relevant reportable segment. In the end, the ultimate goal of IFRS 5 is clarity. By isolating the math and quarantining the financial noise of a divestiture, the standard gives investors a more detailed view of the entity's future operations.